Good day, everyone. My name is Akilan Karuna, and I'm excited to have recently joined Munro Partners as the first international appointment based here in Toronto, Canada. At Munro Partners, we are global growth equities investors, managing in excess of $2 billion in assets under management. Our capabilities are distributed in Canada via CI Investments. Our flagship global long-short portfolio is offered in Canada as a liquid alternative called the CI Munro Alternative Global Growth Fund. We also have global long-only equities capabilities. Today, I'm excited to have on the call, live from Melbourne, Australia, Munro's founding partner and Chief Investment Officer, Nick Griffin. So Nick, markets have been quite volatile year to date. Can we quickly discuss our fund's performance and what tools that we have used to generate our fund returns?
Yeah, look, thanks, Akilan. Look, it's been an amazing first half of the year, and I think for everybody watching, it's been very obviously volatile period in our lives and a volatile period in markets. The funds are up roughly 18% year to date, and from our point of view, it's been a tale of sort of two quarters. The first quarter, we were in capital protection mode, and we had to protect capital as the COVID crisis hit. In the second quarter, we had to participate in the upside that a number of our growth companies have achieved over this period. And so of that 18%, it's interesting in the fact that half of it really comes from our long investments, but just over half of it really comes from our ability to protect capital either via our short selling or via our hedging tools in the first half of the year. And that's obviously come together to create a good first half for the fund.
Great, thanks for that, Nick. So you mentioned a sizable portion of the fund's performance has been generated from our hedging decisions. Can you possibly dive into how we would utilize some of our risk management capabilities and tools should we see another downturn?
Yeah, so ultimately we need to be a little bit humble here because the COVID situation, the long-term effects are probably somewhat unknowable. It's very difficult to work out what the long-term effects will be here, and we're clearly in uncharted waters for many of us in the funds management community. So we need to be a little bit humble about how we approach the next 6 to 12 or 24 months. From our point of view, the hedging tools we have available are a range, but the ones that worked well for us in the first half of the year were things like put options on the market. Put options worked very well for us in the first half of the year. Second thing would be ability to short sell both stocks and futures when things get, I suppose, overbought to a certain extent, or certain companies have gone up when they probably should have gone down. The third area we can use is really the currency, so we can add US dollars, more US dollar exposure to the fund. And the last one is probably the best one, the one that always works well, is we can just add a bit more cash. The fund can hold up to 100% cash at any one time, and we can just build up our cash reserves if we get a little bit worried over the medium term.
All right, thanks very much for that, Nick. So I want to maybe switch gears into looking on the outlook side of things. Can we discuss potentially the COVID scenario and how it looks today, but more importantly, what the team's views are in the short term, and then let's shift over to the medium to long-term outlook.
Yeah, so as I said earlier, I mean, obviously we do need to be a little bit humble about what the potential outlook is here because it is very uncertain. And so over the short term, you know, it's fairly obvious markets have moved a long way fairly quickly. And a number of those capital protection tools may be required over the short term or over the medium term. Longer term though, however, we would look at COVID and say that from our point of view, we'd look at it like any other structural change the fund has had to deal with over the last 15 to 20 years that we've been running money. Ultimately, COVID is a structural shift towards social distancing. And that social distancing has meant for the companies that we look at, and particularly in these digital industries, we see a digital acceleration occurring. And so the simple analysis we'd give you here is if we look at a number of the S-curves of adoption that we've been following for some time, and I'll give you one example being cash or cash to card. Card payments were roughly only 35% of all payments roughly 10, 15 years ago, and that's slowly risen to 60% over time. As we move forward in a post-COVID world, it's fairly obvious that the cash to card shift will accelerate, i.e. cash will disappear much quicker than we previously thought. The other obvious area would be somewhere like e-commerce, where e-commerce has been slowly taking share from regular commerce. And so from our point of view, we would actually see that e-commerce share accelerate. And the simple numbers we could give you is that that it's taken roughly 20 years for e-commerce to go from 0 to 18% of retail sales, but it's only taken 6 months for e-commerce to go from 18 to 25% in the US. So it's added 7% of share just in the first half of this year. And so from that point of view, for a number of these key companies that are exposed to these areas, they have become truly unique. They are accelerating their share of a pie that's obviously not getting bigger, might be getting smaller, but their earnings are being pulled forward. And we're seeing that pull forward of earnings, which is basically driving these share prices higher. And from our point of view, that doesn't look out of place at this point in time. It may have happened a bit quicker than most people think, but it doesn't look out of place. And if anything, it's probably got further to run the longer this crisis goes on for.
Great, thanks for that, Nick. So I want to bring up a topic that I believe we discussed quite a bit in our team meetings, and it's in regards to valuation. And this directly brings up the topic of growth versus value. Can you sort of bring the team's views to that ever so popular topic today?
Yeah, and so Akilan, you're probably going to get quite a long answer here, and I apologize because it's something that comes up a lot. And I suppose what we wanted to flag is obviously this is becoming quite prevalent in a post-COVID world. But there really are two things going on here. One is that the discount rate has collapsed to a very low rate, and on the one hand, this discount rate has collapsed, and on the other hand, you're seeing this pull forward of demand for digital businesses, but also for healthcare businesses and many growth or disruptive businesses around the world. And together, that's seeing valuations go higher. In the short term, as we said, that sort of makes sense to us. And in the longer term, the longer this goes on, you should probably expect that to continue happening. But if you actually look a bit longer out, this has actually been happening for quite some time. And this concept of growth versus value is I think, somewhat misunderstood. And we understand the growth companies get ahead of themselves sometime, but we think the core underlying thesis is misunderstood. And I think the core underlying thesis here is for most of the naysayers is fairly simple, is they would say that interest rates have fallen from 20% to 1%, i.e. the discount rate's gone down, and so these stocks have gone up a lot. And I always say to that argument, yeah, that's exactly true, because Reed Hastings set up a DVD delivery service in California and turned it into Netflix in less than 15 years. And that only happened because interest rates fell from 20% to 1%. Or that Jeff Bezos, set up a bookstore in his garage and in 20 years turned it into $1.6 trillion of market cap. And that only happened because interest rates went from 20% to basically zero. And so the answer is no, there's actually something else going on here. And there's clearly something else going on here, and there's something else that's been going on for some time. And the thing that we would point to, and we'd point to quite regularly, is this concept of Moore's Law. And so we're very lucky that we actually live in this time of digital transformation. I know we don't feel lucky today, but we are lucky that we do live in this time. And so what's been happening with Moore's Law, or what's been happening with technology for a very long period of time now, is computers has effectively got faster. The first semiconductor that Intel created in 1971 by Gordon Moore had roughly 2,000 transistors on it. But every 2 years that's doubled. And as that's continued to double, it's effectively turned into an exponential. And you now have the latest transistors in the markets, or the latest semiconductor setups in the market, the NVIDIA A100 by Jensen Huang, which has 54 billion transistors on it. And so as these computers get more powerful, disruption accelerates. And the simple way for people or the viewers to understand this is just think about what the internet is being able to do for you in your lifetime. It's gone from being able to send an email to being able to create a search engine, to effectively getting on your telephone, to ultimately streaming video, to ultimately allowing collaborative video games, and then finally moving into areas like software, etc., where we can create companies like Zoom, for instance, which is the latest disruptive company in the market. And so what we're saying is, as these computers get faster, disruption accelerates. And as disruption accelerates, more and more of these companies start appearing. So if you consider this acceleration of Moore's Law and this acceleration of disruption, if we then take that and look at what's been happening over the last 10 to 15 years, and we look at some of the bigger winners in the share market over that time frame, what we can see more and more consistently is these big companies that are using this technology. They're investing heavily in this R&D to drive sales growth. And these are effectively the big platform companies that we've talked about over and over and over here at Munro, whether that's Amazon or whether that's Alibaba. And they invest heavily in this R&D. They invest heavily knowing that this equation will improve for them over time and drive sales growth across that. And what's I think most interesting post the crisis is the number of companies that have been so-called shareholder friendly through this crisis and ultimately bought back stock, or paid dividends and not invested in their company are not actually being rewarded by the market. And so if you assume everything I just said there, Akilan, is correct, and we roll this forward to the next 10 years, then it becomes abundantly apparent to us that the way that companies win in the future is to spend money. The way that companies win in the future is to spend on their businesses, to grow their businesses, to become one of these very few winners that we've seen over the last decade. And if we actually go back over the last decade, if we look at it from the peak in 2007 to the peak in 2020, so peak to peak, and we look at the 66 companies over that time frame in the US S&P 500 that went up more than 10 times in value, a vast majority of them have revenue growth in excess of 10% per annum. In fact, many of them have revenue growth in excess of 20% per annum. And on top of that, many of them have PE multiples that are well above 20 to 30 times, and in many cases are losing money. And so if you take everything I've said as true, then it's abundantly clear to us as we look forward that if your job as an equity investor is to find these very few winners, your job as an equity investor is to find these companies and invest them over the time, and particularly as a growth investor. And so inevitably we have to take a much longer term view than a short-term multiple is going to give us. That's what has rewarded us for the last 10 years, and we see nothing in the trends going forward that will suggest that this scenario will change. If anything, it's likely to get worse. And so while I know the growth versus value discussion focuses very much on near-term multiples, I would just finally conclude by saying that focusing on near-term multiples is not going to help you here in the long run. And ultimately, if you are looking at a near-term multiple, you are effectively just taking a shortcut. You are being somewhat lazy in your analysis. And so the last thing we'd say is that we're not actually saying we are not value investors. We are value investors. We do think these companies are cheap. We're just taking a much longer term view about how the world will change and how these companies could win over that time frame. And are they doing the right things to invest to win over that time frame? Because it's abundantly clear to us that the companies that do invest are the ones that win in the long run. And I apologize, Akilan, it was the long answer I threatened it would be.
No, that was great, Nick. And I really appreciate the perspectives there. And we've heard it time and time again throughout the year. A lot of the companies that we've been covering have been openly discussing the accelerations in their respective industries. So it's very well appreciated. Outside of technology, because that's clearly been one of the structural winners in the last little while, what are key areas of interest and fund positioning for our portfolios over the medium to the long term?
Yeah, thanks, Akilan. And you're right, we've spent a lot of time on technology here. It's important to understand that that's just one part of what we do. It is probably the most exciting part of the market right now, so a lot of questions there. But this same equation, we see it appearing in other places in the market. And so the other big areas that we do want to invest in is, from our point of view, is we know what the COVID crisis is now. We know it's a social distancing issue, and we know it's going to involve a lot of testings, a lot of healthcare. So the key areas one of the key areas we like going forward is healthcare. We do like innovative healthcare companies, and here we're really focused on these diagnostic type companies, the companies that are at the forefront of testing. And here we're thinking about things like Thermo Fisher and things like Danaher and things like Lonza in Switzerland. And so from our point of view, these are the companies that are going to help us get back to normal. They're the companies that are going to do the testing, they're going to build the vaccine, and they are ultimately winners, or they are net better off in a post-COVID world. And so that's the one area, which is healthcare, and we're very focused on that. The other area is one that we were talking about a lot pre the crisis, and we do think it will come back, and this is climate change. Obviously, a lot of stimulus is going to be required to get us back or get economies back on their feet. It seems a really obvious time to spend that money on climate. And so what we see in Europe is the new Green Deal is happening. It's going to be roughly $7 trillion of investment they think is required to get to carbon neutral by 2050. And we think the momentum behind getting to carbon neutral is actually probably still going to accelerate here in a post-COVID world. And so from that point of view, we are looking at a number of these renewable energy companies and companies that will help us get to this point, because we think this is, again, one of the great S-curves that we see into the future. And this one's actually just at the beginning today.
All right. No, thanks for that, Nick. And I think we covered quite a bit today, and I appreciate the insights. Is there any final thoughts and insights that you want to leave with our investors before we close the call?
Yeah, I mean, I think obviously it's a very uncertain time, and we understand that for our investors, and we understand and we are very watchful for what are the things that we haven't considered here. But the things that we have considered is if you look at how the fund is positioned, we show you on our website every quarter the areas of interest we're focused on, and a number of holdings and indicative positions we're looking at. And if you look at these different areas, in every one, the fund has decided to look for certainty. We're basically looking at areas where we know that companies will be net better off in a post-COVID world. We know that their businesses are probably going to accelerate from here, and hence we know that their earnings will accelerate from here. And so what we are expecting is their share price to follow earnings over the months and years ahead. And aside from that, look, we understand that there's got probably a few more twists and turns on the road along the way, and we'd merely just point to our track record or the ability of the fund to be nimble to deal with those. And if you combine those two things together, we still remain reasonably confident that we can achieve what we look for, which is meaningful risk-adjusted returns for our clients over the cycle. And that's hopefully what we can continue to do this year and into the years ahead.
Thanks again, Nick, for sharing our team's insights and views. To all our viewers, thank you very much for taking the time to tune in. On behalf of all of us at Munro Partners, we sincerely thank you for taking the time out of your day to learn from our perspectives. As mentioned, Munro's capabilities are available in Canada via CI Investments. In recognition of our growth and success in this region, my role was created to provide local support and ongoing communication to our clients and partners in North America. I look forward to meeting many of you, and any of us at Munro Partners can be contacted via your CI sales representative. Thank you again for your ongoing support and interest of Munro Partners. Until next time, stay well and be safe. Thank you.